Okay, good afternoon, everybody. Thanks for joining us in this new era we find ourselves in, where we are all social distancing and quarantining and staying at home and confined to our locations. What we are trying to do at Pacer ETFs is to basically do 2 lunch meetings a day on Tuesdays and Thursdays, one for the East Coast and one for the West Coast. So this is the East Coast version of our Tuesday lunch meeting. It'll be a Trendpilot update. We'll cover where we stand today. We'll do a little refresher on the rules and why we use the rules we do. And then we'll get into implementation. There is a Q&A tab or a chat tab. If you have questions as we're going along and you want to ask that question, you can just simply type in the question, and I will do my best to pick them up as we're going along. My name is Sean O'Hara. I'm with Pacer ETF. So let's begin. The first 2 slides are just essentially reminders for us in terms of getting out too early. It's serious. This slide's one we've been using for a while, and it's kind of an eerie slide if you think about it. If you look at the peaks before the bear market cycles going all the way back to the 20s, the average return from that peak to 1 year back is 33%. So we do get a lot of our return in the last year of a bull market. That number is pretty close to what the 2019 return was on the S&P. So getting out early is a challenge, and then we all know staying too long can also be a challenge. This is the average bear market going back to the 20s as well. The average decline is 40%, and the average length of those bear markets is about 1.6 years, not 1.6 days like it seems we're in today. We believe in trend following at Pacer ETFs. We have a whole series of trend following ETFs, from large cap, which uses the S&P 500, to a mid cap story, to a NASDAQ version, to an international and a European version. We have a fund-to-funds version of Trendpilot, and we have a fixed income version that rotates from high yield to treasuries. And the reason that we like trend following is if you look at the last 6 bear markets in the U.S., the red bar would be your peak to trough decline in that bear market cycle, and the yellow bar would indicate how much of that decline you actually experienced. This brochure is available for client use and has been used very effectively to prospect with. Particularly, I would think in this environment where it seems like every day we look at the market and it's up 2% or 5% or 10% or down 2% or 5% or 10%. It's a very abnormal market cycle we're going through. The brochure also has a video that goes with it, and I would encourage you to get a hold of that as well. The video is client approved. And just sending a couple emails a day out to clients during these times saying, hey, take a look at this video. It lasts 2 minutes long, and read this brochure. I think this might make sense in your portfolio. Has been very effective for us in terms of gathering assets and working with FAs, whether they're prospects or additional assets from existing clients. Another way to look at the 200-day moving average is this chart. This is the S&P 500 going back to 1999. So you can see when the tech bubble busted, the peak to trough decline in the market was 47%. Using a 200-day moving average as your exit point would have limited that loss to about 11%. And then you have the financial crisis and a 55% decline versus about a 7% decline. So how does Trendpilot work? It's really simple. It's like a traffic light. It's green, yellow, and red. Green means go, yellow means slow down, and red means stop. Whenever the index that we're tracking, in this case we're using the S&P 500 as the example, is above its 200-day moving average, we will own the S&P 500 in the exact way that S&P says we're supposed to, so all 500 or so stocks in the exact weights. Same thing would be true for the NASDAQ or a mid-cap index or an international index. When the index falls below its moving average for 5 consecutive days, that's our first trigger, our first signal. Half the portfolio will go to T-bills. And you'll notice in the side boxes that the yellow box is the only box with 2 arrows. This is our decision-making box, if you will, or our wait-and-see box, our slow-down box. And either one of 2 things will happen when we're in the 50-50 mode. Either the market will go back above its 200-day simple moving average, in which case we'll go back to 100% long, or while we're in that 50-50 mode, the 200-day moving average will turn negative instead of positive. So it'll stop going up and it'll change direction and go down. If while we're in that 50-50 mode, that happens, the rest of the portfolio will go to T-bills. Once we're in the T-bill mode, the only place to go is all the way back to 100% long, and that will happen when whatever index we're tracking goes back above its 200-day simple moving average. And so those rules are the same pretty much for every version. I'll explain to you in a little bit later in a slide why we use the two-step out and one-step in, that's I'm reading a question. I'm sorry. Yeah, we will make the slides available to everybody who wants them. So using the S&P 500 as your example and getting some help from S&P on this, this is what would happen to the S&P 500 going back to 1999 if you use the methodology that's the Trendpilot methodology. What it shows you is that over time you'll get a higher return than your benchmark, not by producing excess returns in up markets, but by eliminating some portion, if not a big portion, of the big declines. And so when you look at the average annual return going back to 1999, it's 7.39% for the Trendpilot versus 6.05% for the S&P 500. And the big numbers are the ones down below, where the worst decline for Trendpilot would have been 5%, almost 6%. That would have been in 2011, not 2008. And the worst decline for the S&P would have been down 37% in 2008. On the upside, when the market goes up really fast for a while, like in 2013, we catch basically almost all, if not all, of the upside. So the whole idea about this strategy is to try to minimize the downside at some point, or just simply go to the sidelines and say, I'm going to sit in cash and not go down anymore. So if you look at the next slide, this is our tracker. This shows you exactly where we are. It's on our website every single day. It's also available to FAs if they want to get it. If you want to get on the email list, we send this out on Mondays. What you're looking at here is large cap version of it, and so you can see that we're in 100% Treasury bills right now. It also tells you how far above or below the 200-day moving average we are, and in that middle column, what is the current direction of the moving average. So the moving average on the S&P 500 now is going down 25 or 24 basis points a day. And then you can see on the chart below when we exited the S&P 500, which was about, I don't know, a week and a half ago, I guess. So I'm not going to go through every single one of these, but they all work essentially the same way. The Trendpilot that tracks the NASDAQ 100 is in the 50-50 mode currently, so it's half out in treasuries and still half in equities. Mid-cap is out completely. Europe is out completely. International is out completely. And high yield is out completely, or the bond fund version of the Trendpilots are out completely. This just shows you going back the last 3 years through the end of the year in 2019, what happened on a live basis with Trendpilot. The blue line is the S&P 500. The green line is the Trendpilot. You can see we missed a big portion of that decline in 2018, sort of rode straight across. And then you can see we would have picked up a little bit after the market started to rise. And so over this 3-year period, $10,000 invested in Trendpilot would have grown to $14,000. $10,000 in the S&P 500 would have grown to about $16,000. But without that, terrible decline we would have experienced in 2018. This is a Morningstar hypo. We send these out on a daily basis. This is showing you mid-cap. So I'll show you some real numbers in a second, but this is, again, the live numbers since inception for the mid-cap strategy. We missed the big declines in 2016. We missed the big declines in 2018, and we missed the big declines in 2020 as well. So here's the current status in terms of year-to-date and month-to-date returns of all the Trendpilots. Large cap is down 19. The market's down 18. We're sitting in T-bills, so we will not go up or down for a while. We'll just sit right here. The mid-cap was down 7% year-to-date as of yesterday, where the mid-cap index was down 29%. NASDAQ is down 13 versus down 9. It's still invested in the 50-50 mode. Europe is down 13 versus 27. Trendpilot International is down 11 versus 22. And then high yield is up 1.73 versus high yield bonds being down 13.9. The hidden gem in the Trendpilot lineup, I think, is the fund of funds version. The ticker is TRND. It's 4 of the Trendpilots all in one ETF. It rebalances automatically on a quarterly basis for you, so there's no taxation on your rebalance. And year to date, it's down 12% versus the global 1200 being down 20. The Trendpilot Fund of Funds has large cap, mid cap, NASDAQ, and international in it. So those are the live numbers. Just a little note on where we stand right now. This is the last 2 bear markets prior to this one, and this one included in the blue there. They're typically, for the last 2, there have been 3 phases to the bull markets, or the bear markets, excuse me. The first phase is the steep drawdown, and then you have almost a relief rally in the middle. And then you can see in 2000 to 2002, or in 2007 to 2009. The third phase is the final frontier, if you will, the big drawdown. And so this relief rally, if the pattern holds, sort of showed up right on time versus all the rest of them. And so being fully invested in T-bills for large cap and mid cap and international and being in the treasury mode for high yield gives us a little comfort. We don't know what's going to happen to the market, just like I think most people would admit. We're all locked in our houses. The economy is in lockdown. There's people that are losing their jobs. It's a horrible situation. And we don't know what the effect of all this is going to be on earnings or GDP yet, or what the final tally will be for unemployment. So for us, for Trendpilot, since its job is to simply at some point just go to the sidelines and say, I'm not going down anymore, we like our position. And if the current trend turns out to be like the last 2 bear markets, then we'll miss that significant third phase of the bear market in the drawdown there as well. So why do we use a 200-day moving average? We use a 200-day moving average because it works the best, and the reason it works the best is counterintuitive if you think about it. A 50-day moving average or a 100-day moving average or a 150-day moving average will go quicker than a 200-day moving average, but what comes with that is more moves. So if you use a 50-day moving average against an index like the S&P 500, you would have only made 3.3% as opposed to 5.9%. And you would have made almost 3 times the switches, 352 changes versus 144. And we know when we use any system, any methodology that uses technical signal like the 200-day moving average, that it's not perfect. It's going to make decisions from time to time that are not the right decision. And that's why we believe that it actually outproduces the shorter moving averages, because it makes less total decisions and therefore fewer mistakes than if you were to change 352 times as opposed to 144. And then why do we use a 5-day confirmation instead of a 1-day confirmation? Again, if you look at the bottom, 1-day confirmations cause you to make a whole bunch more switches than waiting 5 days to see if the trend is really a real trend or not. And you also wind up with a lower return. So when we built the index, the 2 things that were critical to us was we wanted the 200-day moving average and we wanted a 5-day confirmation, because shortening those things up, even though you would move faster one way or the other, actually produce a lesser outcome or a lower return. And so this slide right here looks kind of like a wheel. It shows you the 4 different phases the market could be in. The upper left-hand part of the circle is when the index is above its 200-day moving average. That's about 70% of all the days in the market. And the average return for stocks during those periods is great. It's about 9.5%. It's why we own equities, or why we like to own equities. In the bottom left-hand part of the circle, that's showing you the index is below its moving average, but the moving average is continuing to rise during those days in the market, which is about 2% of all days. The returns are still positive, and so that's why we go to the 50-50 mode. And then when you go to the bottom right part of the circle, you'll see that that's when the index is below its moving average and the moving average itself is decreasing. That's about 25% of all days in the market, and the average return for all those days is negative, and that's what we're trying to avoid. And rather than retrace our steps, you can see that once the index pops back above its moving average, which is only about 2% of all the days again initially, the returns are terrific. And so we're not trying to get 100% of the upside, and we're not going to miss 100% of the downside. But if over time, if you can miss a significant portion of the downside and you can catch a big portion of the upside, we believe you should be able to outperform your benchmark without any of the real catastrophic decline scenarios. This is a chart we had been talking about for a while. This is a PE chart. It uses Bob Shiller's PE ratio, which is called the CAPE ratio, cyclically adjusted PE. He, rather than using a 1-year PE, uses a 10-year version of the PE and some smoothing mechanism that he developed. But what it shows us is that the lower PEs are, the better the market does, and the higher PEs are, the worse the market does. So the way you'll read this is on the bottom, if Shiller's PE ratio is under 14, the gray bar shows you the average return going back to the 50s, 5 years forward for the S&P 500 is about 10%. Trendpilot would add a little bit of extra return, but not much during that period. When you get into the second quintile, which is PEs from 14 to 22, two things happen. The average 5-year return on all of the periods that Bob Shiller examined going back to 1954 goes down to 8%, 8.3, and Trendpilot again produces excess return. In the middle quintile, when we're in 22 to 29, according to Shiller, the returns going forward on average for stocks go down again. And now we start to see some separation by the Trendpilot strategies where owning Trendpilot is really more significant. We are still in that fourth quintile, according to Shiller. And when you're in that fourth quintile, going back to the 50s, the average return for the S&P 500 for the next 5 years is about 85 basis points. So it's less than 1%. And that's where Trendpilot really adds a lot of return. And when you get into those really high PE zones, then on average stocks have a negative return and Trendpilot remains positive. And so we had been talking about this chart for the last 2 years, hoping to get people to see that having a little Trendpilot in your portfolio once you get PEs that high could be really beneficial. Traditional asset allocation is what we're trying to show here in terms of drawdowns versus volatility. If you own the S&P 500 outright, which is the gray box, your volatility is 18 and your max drawdown is 55%. For the 60-40 model, your volatility goes down, but your drawdown is still pretty nasty at about 26%. And then Trendpilot by itself has a max drawdown that's lower than either of those two at 17%, and a slightly higher volatility than the 60-40 model, but not anywhere near what the volatility would be on the S&P 500. So how do FAs implement? This is our implementation page. There's basically 3 ways that FAs are using Trendpilots in their portfolios. The first would be in a classic asset allocation sense. If I was your client and we determined my risk tolerance and we built a model based on asset allocation that said I should have 60% of my money in equities and 25% in bonds and 15% in alternatives or other stuff, then the first way we get implementation is FAs are building that equity portfolio with some cheap beta in it, some alpha generation ideas in it, and with Pacer Trendpilot in there solely for the mitigation of the risk on the downside. And so how much goes into each one of those will probably depend on how risk averse the client is. If you can determine how risk averse your clients are, you're better than me, because it always tends to change. A year ago, I would bet that most of your clients said they were far less risk averse than what they're saying today. But generally speaking, about a third is a good starting point, because that gives the Trendpilot enough of the portfolio to provide the mitigation of the risk on the downside, and it gives the other two, the beta and the alpha, enough of the portfolio to drive returns up in up markets. But being clear about that, the FAs that are using Trendpilot are using it for that falling market scenario where we will fall less than the overall market. And then the second way that FAs are using us is in the alternative bucket. Alts up until very, very recently had really done nothing, not that it was their fault, it's just how they're designed. They're supposed to be not correlated to the market. whereas Trendpilot would be highly correlated to the market when the equity market's rising, but not correlated when the market's falling. And so using Trendpilot as an alternative to your alts is a less expensive, more tax-efficient way to replace some of those assets that really won't do much in your portfolio when the market's rising. And then the third way that we're getting implemented into FA portfolios is if you're outsourcing the investment management to somebody else who's creating models for you. Maybe you're using your firm's CIO models. We have a lot of FAs that are just simply pulling a piece of that CIO model or that asset allocation model that somebody else is running, pulling a certain amount of assets off and just creating a little Trendpilot model to go by itself. The easiest way to do this, it's not available on all firms yet, but TRND would be the easiest way to do this, is just take 5 or 10 or 15% of your total portfolio and put it in TRND, and that becomes your risk mitigation bucket. I will remind everybody that PTBD is our bond version of Trendpilot, and so the same thing would be true in that fixed income section of your portfolio. If you own high yield, then replacing your high yield with PTBD automatically will move you from high yield to treasuries, and we covered the returns earlier in the slide about what it's done. So. And then this chart shows you sort of how difficult it is to be a financial advisor if you didn't already know, which I'm sure you all do after the last 3 weeks. But this takes the S&P 500 and goes back to 1999. It examines quarterly rolling 5-year returns. So every quarter we start a new 5-year time series. So between 1999 and the end of December, there were 61 5-year periods. Of those 5-year periods, 10 of them were negative, so a fairly high percentage. The average negative return was 2% a year for 5 years. The best 5-year return was 21%, and the worst 5-year return was minus 4.76%. And the average of all of those periods for the S&P is 7.5, which is why we like equities. They give us a higher return than inflation and allow us to grow our money. If you took half that money and put it into Trendpilot, then you'd still have the same number of rolling returns, 61, but you'd have 0 5-year rolling returns that would be negative. The best 5-year return would be 14.5, so you'd give a little up there, but you wouldn't have any 5-year periods where your returns were negative. And by doing that in combination, you would actually increase your return slightly versus just owning the S&P 500 outright. So you get a slightly better return by allocating half that part of the portfolio to Trendpilot, and you eliminate the negative 5-year rolling returns, which are tough to deal with. This chart, I'm not going to cover both of them. I'm just going to focus on one of them, but these are the 5-year and 10-year rolling returns on Trendpilot versus the S&P. The blue lines are the Trendpilot strategy, and the red lines are the S&P 500. And then what you can see here is that there's no blue lines either in the 5-year or the 10-year rolling periods where there's a negative return. And there are still quite a few 5-year and 10-year returns in the market by itself where you actually get a negative return for either 5 years or a whole decade, 10 years. And I just want to point you to the 10-year rolling chart at the far right-hand side. You can see that the red bars for the last 6 rolling 10-year periods in the S&P 500 were between 12% a year and 16% a year. And so my way of thinking about that is that they were between 50% and 100% higher than the historical average. And when that happens, sooner or later, we have to regress to the mean. And the beauty, again, of what Trendpilot does for you over these extended periods of time is that it eliminates that 5 or 10-year rolling period where you have a negative return. So I just want to throw in 1 or 2 quick additional ideas, just because we all are self-quarantining these days, if you will, and we're all sitting at home instead of going to the office. And what we're hearing about is the strain that this is putting on the internet. We hear stories about rolling supply from one place to the next so that one part of the country can get it. We're hearing stuff about Netflix slowing down their service in Europe. Well, we think there are big thematic growth ideas that we built an ETF for. The first is SRVR, server. Everybody's talking about 5G, but actually there's a bigger story than just 5G. It's about the cloud, it's about streaming, it's about e-commerce, it's about the Internet of Things, AI, all of these things that we all want to continue to grow can't grow unless we have a massive build out in the amount of computing power we have, which is why streaming is under such pressure right now. We just don't have enough data centers. And so with server, what we focus on is publicly traded real estate names that build out data centers, that build out fiber optic networks, and that are cell phone tower companies. And so if you wanted to think of it like this, we think of it like spenders versus receivers. There's going to be people who invest money to build out their business so that they can take advantage of these technologies, and there's going to be people that are going to receive those dollars. On the data center side, you can see the capital expenditures from those folks who are building out their capabilities, and then you can see the major data center REITs revenue going up almost dollar for dollar with that CapEx. And so with server, for the names that are data centers in server, we're basically getting that money to build centers and receiving rents from people who are participating in these data centers. And on the other side, you'll see the 5G revolution. What you'll see is in the shading in the background, the blue chart is AT&T and Verizon's spending on 5G, and then American Tower and Crown Castle's revenue as we went from 1G to 2G to 3G to 4G, and now we're starting to build out 5G. So we want to be in a position where we're building the critical infrastructure for those technologies and receiving, getting paid today, if you will, to do that. And the way that the ETF works is we survey in the box number one all the publicly traded real estate names across the country. We screen them for their revenue type, their tenant type, and their property type. We put in a liquidity and a market cap screen, and then we, on a modified cap-weighted basis, we build the index, which will then become what's in the portfolio. You can see the current top 10 holdings: American Tower, Crown Castle, Equinix. Those first two names are cell phone tower companies. Equinix is a premier data center, publicly traded real estate name in the U.S. You can see Cyrus One in here. They're the Equinix of Europe. And then there's two names in here that you might think don't belong, which is Outfront Media and Lamar. The reason they're in the portfolio is that there are limitations on how many cell phone towers actually can be constructed in the U.S. And Outfront Media and Lamar Advertising are the two companies that control all the billboards all across the highway system throughout the U.S. And they're now being turned into dual-purpose, freestanding operations where they are going to continue to be billboards, but what they're going to be doing is putting cell phone tower nodes on those billboards as we have to have more and more cell phone towers and more cell phone tower nodes in order to get from 4G to 5G. And so that's the server story, and that's it. And so I just want to just stop here and say if you have questions, you can type them in. I think Steve asked a question about the materials, so we will send out a copy of the slides to anybody that wants them, but I'll give everybody another minute or so to ask any questions by using the chat bar that chooses to. I'll wait here for a minute and see how we do. And we're not getting a question. So I guess that will conclude the web lunch meeting for the day. There's our phone number, 800-577-2000. If you have questions, if you want to receive the slides, give us a call. What are you doing about T-bills? Here's a great question. What are you doing about T-bills having negative yields? Are you using institutional money market of sorts or what? Right now, the yield on Treasury bills for new bills issued are negative. The T-bill index that we built allows us to own 90 days all the way down to 30 days of maturity remaining on a T-bill. And for now, what we're doing is we're stacking the money on the 90-day because it has the highest yield. Eventually, if the yields don't turn positive again, then we will have a negative yield on T-bills. And so we will go down little by little every day while we're in the T-bill mode. We'll tell you we did have a call this week with U.S. Bank, who's our custody group, about using an institutional money market for part of that portfolio. the yield is a little bit higher than what T-bills are, but there's a trade-off, and I'm not sure yet that we're wanting to make that trade-off. The trade-off is that we would then be assuming the credit risk of U.S. Bank or anybody else's institutional money market fund that we took on, and so we have to balance that out. But we are looking at that, and we do have the ability to do that with a portion of the portfolio if we think it's the right thing to do. I just don't want to be the guy who's responsible for an organization that takes a whole bunch of money, billions of dollars, and puts it in somebody's money market fund, and then we have a financial crisis the likes of we've never seen before. And instead of getting a slightly negative return on T-bills that are backed by the government, you have a bigger problem. But we are looking at it, but that's what's holding us back right now. So that's the other question. And any other questions? Well, great. We will conclude then. Again, our phone number, 800-577-2000. Give us a shout if you want the slides. Our wholesalers are doing virtual meetings. Everybody's now equipped with their own conference call number and has a Zoom account. So if you wanted to have a meeting with our wholesalers during this time when we're not able to go into the offices, we're doing lots and lots of meetings that way. We also have a replay of this available, so if you think you have any colleagues that you think should hear about what we talked about today, we'd be happy to send that out as well, the link to it. So, and that's it. So no more questions. So we'll wrap it up. Thanks for being on today, and we appreciate you guys being here.